this working? Cool. Um, Hello there and welcome. Um, yeah, basically, we're gonna be going over kind of like a guide of how I invest in the market. So, first of all, we want to go to the Columbus Metropolitan Library. That's if you are a resident in Ohio. Go up here to get a card. Next thing you want to do, apply for a card, acknowledge next, blah blah blah. Insert your information and then submit that. Eventually, I believe you'll get an email confirmation of like how to log in and stuff. But so once you do that process, what you'll do is go back to the Columbus Library website and then hit this research right here. Once you click on that, go to research tools and then type in Morningstar. Then you'll search. It'll bring up this Morningstar Investing Center. That's what we're going to be using. So when you click on that, it'll bring you to this. Basically, this is like a tool that I use to make more informed decisions when it comes to investing. This is one of the free tools that I use. Is this Morningstar Investing Center? I mean, it's free. You just have to sign up for a library card. But my favorite tool here is the screen. So what you can do with the screen is kind of narrow down securities to certain standards. You can put limitations on the securities for what you're looking for. But what I look for mainly is I go to the ratings. So like what Morningstar does. Oh, oops, I know what I meant to do. Apologies. So anyway, what Morningstar does is they rate their stocks 1 to 5, 1 to 5 stars. So 1 star meaning the stock might be either at or above its fair market value, or what they calculate as their fair market value, or it's maybe slightly under that price. But so if you're looking for a deal, which I don't know about you, but I like buying low and selling high. You want these 4 star, 5 stars because this is going to show you the stocks that have been taking a beating, or they've had catalysts that have raised the fair market value that Morningstar has calculated, and so now the current stock price is at a discount to what their fair market value is that they have calculated. But so I like applying 4 and 5 stars here, and then for economic moats. So if you were to think of your company as a castle type of thing, like back in medieval days, your moat is basically what protects your castle. So for your company, your moat would be anything that would protect your company. Like, for example, patents, like a patent that you guys have a trademark on, or that company has a trademark on, that would be considered like a positive thing for the moat. So a company with a wide moat has more of those examples for the company. They have more diversification in the company to kind of protect the company itself, type of thing. And then another moat is kind of similar. They have some protection, but not as much as a wide moat would. So I like looking for companies that at least have a moat because that can, you know, that could potentially help them in the longer run when they're competing with competitors. So, um, another thing that I sometimes use is this capital allocation. It really depends on what sector I'm looking at. Like if I'm looking into a sector where their capital allocation maybe plays a vital role in performance, then I might use this tool. But for now, we're not gonna use that. It's uncertainty, so this could be very nice at times if if you want a stock, if you have money and you know that you want that money to be there within the next few years, you probably would filter for low to medium uncertainty stocks. But if you don't really care about the money that you're putting into the market, and all you care about is growth, then you can be medium high, very high uncertainty or extreme uncertainty. Because the more risk that you take on, the more reward that you will reap within the market. So, but most of the time, when you're dealing with these 4 or 5 star companies, they're going to be uncertain because they have the reason that they've taken a beating. Like there is a reason why they've taken a beating, and that's because there's something affecting either them directly or the industry that they're in. And so most of the time it's going to be a high uncertainty company. But if you can find, a 4 or 5 star company that they deem is a low uncertainty, then I would say that would probably be a good buy. So if you wanted to firstly, look see if there's any low uncertainty companies that are 4 or 5 star buys, you can just do that first and then expand your search. After that, there's not that many, but we'll just stick with this for now. And then for the reference, I always go to the exchange country and just type in United States. That way it populates um, the ticker symbols that are on the US exchanges. So it's just easier to find the exact match when you're looking for it. And then the rest of this I don't really care about, so because I do my own research when it comes to that. But then next thing I do is hit apply, and then it will populate stocks according to your constraints. So right here, with low uncertainty stocks that are wide and narrow modes that are 4 and 5 stars, there are 202 securities like that. So I don't really, I don't really recommend having a lot of stocks in your portfolio. Mainly that's because that eventually it would deteriorate how much return you make over time. In my personal thesis, my personal perspectives, I limit myself to no more than 10 companies in my portfolio at a time. And that's just because most of the time I'm buying into a price that I believe is a cheap price for the company, and I'm willing to take that risk of it going down a little more and holding it long term and, you know, making a substantial gain on that. I don't even know where I was going with that, but okay. Yeah, well, I was rambling too much. I lost my train of thought. But anyway, yeah. Um, so what you can do is, I don't know where I was going with that. You can narrow down your search some more. So you can take the 4 star off. And then, in all honesty, I don't like this. Like all I care about is the hard facts, so I usually turn that off as well. So we narrow it down even more. Okay, I kind of remember where I was going with that. Anyway, like I'm more comfortable taking like buying these low uncertainty companies that are 5 stars because I'm buying it at a cheaper price than what I would be at a 4 star. That's where I was kind of going with that. So that's why I was kind of explaining why you would take the 4 star off, but I was just yapping too much. So here we're looking at wide and narrow moat 5 star companies. There are 8 of them, and as you can tell, I've already looked at 6 of these. So I usually like to stay on top of things here. But so for example, so this was one that kind of intrigued me a little bit. So we'll look at this one together. So for General Mills Company, so old General Mills Inc., I guess. So, cereals and stuff like that. So what you do is you just click on the name or the ticker, whichever one, and then it'll bring you to this screen. And usually the first couple things that I look at when I get to this screen is I just like to take a peek at the equity style box. To kind of explain this, your bottom row here, so you have your small value. Oh, my laptop's about to die. I was like, why not dim down so much? Sorry. 1 second. Um, so yeah, at the bottom left here, you have your small value companies. In the middle, you have your mix. So it's a like small mix, and then on the right side, you have small growth, and then it's mid value, mid mix, mid growth, and then large value, large mix, large growth. So usually I like to look there because that kind of gives me an indicator of like how they, what they kind of like, what kind of name they put on it right now. And so like right now they have it as mid value. So that tells me that it's a mid-size company and that they classify it as being a value asset instead of a growth asset because General Mills, there's really not much growth there, but if it was a mix, then it means it's like, fairly valued type of thing. Or they, it's a company that kind of does, it has some, so like, I guess, for example, would be like, I would consider Walmart as like a mix because, they're always trying to expand and try to get bigger as being such a large company and being a very mature company. So, like here recently, they've been expanding a lot to their online services, their Walmart.com, and it's been paying off for them here recently. Their stock price has appreciated from it. So, but here in General Mills' case, they're not really doing that much growing, so they're considered mid value as their stock price has taken a pretty big drop since 2023. Um, so that's usually the first thing that I look at. And then the next thing I look at is the sector, consumer defensive. So really, it depends upon what time of the economic cycle that you're in, of which like sectors you should be investing in. So for example, consumer defensive is a sector that you would invest in if we were in a downturn or like an uncertain point of our economy. If we're a little unsure of what the possible outcomes could be within the next year or two. So that's when you would want to start leaning more towards consumer defensive because stocks that are considered defensive are companies that sell products that basically every human needs in order to survive life. So, like, for example, General Mills, they sell cereal, they sell whatever else they sell, nutrition bars, whatever it is, which those could be things considered as things that somebody needs in order to live, type of thing. Um, and then like Procter and Gamble, they sell all sorts of things, and then you have um, Campbell's. you have Campbell's Soup, you have Kraft Heinz. I mean, there's a bunch of these type of companies, but so sectors really play a role depending on where you're at in the time that you're currently in. And so currently, I would consider consumer defensive a good buy because of the current economic situation that we're facing as of today, the 23rd of December in 2025. I wouldn't be mad with buying and holding consumer defensive right now. The problem is right now is that we're at a time and place that there's a little bit of uncertainty and there's a little bit of certainty. And, you know, there's all this investment being done in AI, but there's really been no outcome of said investments. So it's kind of like a waiting game. It's consolidating currently, and investors are just waiting for more data or more information to, kind of push the market to its next step. So you just gotta be aware of your surroundings and what's going on. So, but yeah, so those are the first two things I look at. And then what I usually look at is the price to earnings ratio. So what a price to earnings ratio is if you take the price of the stock, which right now it's $46.64, you take the price of the stock and put it at your denominator, or no, excuse me, whatever the other one is, the one on top. Put that on top, and then your earnings, so the earnings per share, you put that on the bottom. Divide the two, you get the price to earnings ratio. So on average, an average price to earnings ratio, I would say is about 20. I would say 20 is a pretty healthy number for PE. Anything below that point, I would say that fundamentally the company is undervalued based off of that. Anything above 20, I would say to be a little cautious. Anything over 30, you're expecting the company to outpace itself basically, and not entirely. So a high PE, it means that the stock price is more. The higher it is, the more the stock price is inflated compared to what how much the company is actually earning. So like you're basically betting that the company is going to earn that much money the next year, the higher the PE is that you buy into. So that's just a risk that you have to take on. So I like to look for companies that are like 15 or below because that means I'm not taking on too much of a risk if they're making that much money. Their stock price is pretty low, or if their earnings are relatively close to their price, then I'm not mad at taking on that risk. So that's the next thing I look at, and then I usually look at if it pays a dividend or not. Dividends are cool. I don't mind dividends. Um, yeah, I have no hate for dividends. So, um, and then usually I look here, see what their fair value assessment is. Um, Fair value of 60 with an uncertainty of low. So it's trading at a 21% discount to what they have it at with a low uncertainty. So that to me, it's kind of like, okay, those are both pretty good signs, in all honesty. And the PE ratio also being a good sign as well. So far so good. And then I usually take a look. I'll sometimes skim these if I just want like a better understanding of a company I may not know. I mean, I have a general understanding of General Mills and what they do and the products they sell, so I don't really need to read anything here unless I want to know more about competitors because sometimes we'll talk about competitors in here as well. So, but then I usually just look at this is a chart over the past 10 years. So, as you can see here, it hit a peak here in 2023 of around 80 or no $90 a share, and right now it's trading at about 46, 47, $47 a share. So from its highs, it's trading at about what is that? 50% discounts, 55, something like that. So we see that it's trading low. Don't care about this. That's just nonsense. Next thing I look at here is the revenue. So firstly, what I do is I switch this to 10 years because I like to see the 10-year trend. I don't think 5 years is enough data. In all honesty, I think 10 years is better. But so we go back from 2016, they were making 16 billion because it tells you here it's in billions except for ratios. So $16 billion, and then it drops a little bit back to 16. It's just steadily continued to go up slightly. And if you go back here through those years, stock price was higher. So that's kind of a questionable thing. Next thing you look at is the gross profit. So gross profit has kind of deteriorated a little bit. So that's kind of a red flag. So that kind of that's kind of confirmation to why the stock price may be going down, type of thing. You want gross profits to either go up or remain steady. You don't want them to go down. So it's usually revenues, gross profits, and then I look at the net income. Net income has gone up ever so slightly as well over the past 10 years. Earnings per share has gone up, almost doubled over the 10 years. A pretty decent sign. You don't have to look at the earnings per share. It's just something that just caught my eye right there. And then the next thing I do is look at the assets, liabilities, debt. I look at most of this stuff, but the first thing that I look at is the debt to equity because that tells me if they're taking on more risk than what they actually like. How much it's kind of an indicator of how much risk they're taking on because like for every dollar that they lose, they're actually losing $1.66 when it comes to that. But not entirely, but basically. Um, they'll lose more money than what they actually should, but then for every dollar they make, it's $1.66. So wait, you can think about that. Okay, what's going on? And then yeah, I usually look at the assets and liabilities and look at them over the years. So you can see assets have increased more than their liabilities have over the years. I believe, yeah. If not, it's about on par. So not a terrible thing. Next thing I do, profitability and efficiency. This is a key factor, in my opinion. So, return on invested capital. So, what this basically tells you how much money they're making on the money that they are investing. So, pretty average number that you want to look for here is 20%. You can find 20%, and if a company has an ROIC of 20%, they've had steady revenue growth, they've had pretty steady profit margins or increasing profit margins. They had a low debt to equity, all these factors combined, and then they have a 20% ROIC. And on top of that, their stock price is down 20% over the year. You will be buying, like, I would be buying that company up in a heartbeat. Like, that's just like, you know, a, the golden rule type of thing there. But yeah, so ROIC is important because like how are they doing with the money that they're investing type of thing, they have their business, but then if, as a shareholder you want the business to expand, so they have to invest their money. So how much are they making on that invested money there? And then you have your return on equity. How much money are they making back from their equity? And then how much money they're making on their assets. Boom. These two are, I mean, yeah, they play a role, but I think this one here is the most important. So 12% is pretty mediocre. Nothing catching my eye there. Current ratio, quick ratio. I mean, yeah, these things can play a factor, but I don't, I've come to over the years notice that they don't really matter. So like the things that I pointed out, it's really the only things you need to focus on and pay attention to when going through this stuff. But I usually you can look at the financial statements. I don't. These things up here are from the financial statements. They tell you everything you need to know. Um, and yeah, I mean, that's basically about it for analyzing a company. And then what I usually do as well is I try to stay on top here. So what you can do is just look up Bloomberg economic calendar, and what it would do is it will pop up with a link. It'll take you here. So what the economic calendar does, it kind of give it like it will tell you events that are going on related to like the economic state of the economy. So what I usually do is I clear this filter first, and then I just filter it down to the United States because those are the only companies that I deal with are companies in the U.S. I don't really care about what else is going on. Uh, I mean, I shouldn't really say that, but I mean, to be fair, that's kind of how I've been rolling. Yeah, I mean, it's good to be informed, but when it comes to economics, I feel like if you know what's going on with the United States, you have a general sense of what's going on with the world because the world's economy kind of relies on the United States economy. So, um, but yeah, so I filter down to the U.S. I see what's going on in the U.S. What you can do here, if you don't know what something is, all you have to do is just click on it, and it will tell you an overview of what that is and what a good thing is and what a bad thing is. It will break it down for you. Most of the time, if you see these red numbers, then it's a bad thing. If it's green, it's a good thing. If it's black, it's really nor it's neither good nor bad. So I use this. I'm not gonna really explain it much more than that because I think it's better for you to just click on these things and read them and try to create your own understanding. Um, but this is a very helpful tool for me as well. So definitely recommend using this tool. I would say these are the best two free tools that you can get as a retail investor right now if you want to become, a pretty serious investor. And then also, like you can mess around on Morningstar all you want. Everything on here is available to you when you log on here. Um, if you're brand new to investing, check out this investing classroom. I mean, there's videos and stuff on here and practice exams and stuff that you can use for learning. And I I personally took some of the exams, and if that's what the stuff on the exams, if that's what they're teaching in those videos, it's actually helpful information. So I would definitely recommend maybe checking that out. And then, like, if you get bored just playing with this stuff, you can get insights from advisors or you can get insights from analysts talking about certain situations and stuff like that on here as well. Like, there's a bunch of tools just right here waiting for you to use. So, yeah, um, that's about it. If you have any questions, go ahead and let me know, and I will try to answer them as best as I can. But yeah, thanks for watching, and I'll catch you later.